Hello and welcome to today's stream. Where what better to do during spring break than to think about, as the video title will say, state-owned enterprises, Petrobras, and think about airline economics through this really nice new a piece from Baron Hobart on his the free edition of his newsletter, which I'm subscribed to. Although I really would like to subscribe to his paid, because he does write a lot, and he does write pretty good stuff. Especially this one, which hopefully you'll see through like the snippets I'll highlight, is a really good and interesting piece that contextualizes a complex industry in tangible and interesting ways. But first of all, uh, let's just dig into state-owned enterprises. And of course, state-owned enterprises, right, are firms or entities that have some degree of government involvement. Of course, when a broad term like that is used, uh, generally in a universal sense to describe companies in very different contexts and industries. Uh, for example, a bank is very different, right, from a regulatory perspective than an industrial company or even a consumer, even an airline, right? But yet, to some degree, you can find examples of a quote unquote state-owned enterprise or SOE in each of those industries. And of course, top onto that, geographies and different regulatory environments and government policies and different uh, jurisdictions. That becomes a very messy, interesting mess. But of course, right? But generally, right? That creates a fog. You label something SOE, and it's like a negative screen. If like you're doing like some ESG screen, right? And you have positive screens where you look for factors that cause you to want to invest, or if you're running a negative screen, which is factors that would cause you to not want to invest. You can imagine an SOE as functionally being a negative screen. Of course, it could be a positive screen if you want to own uh, state-owned enterprises, or a negative screen if you don't want to own state-owned enterprises. But it creates an additional layer of complexity. It makes the narrative, it makes the story a bit more difficult to see. And generally, and when there's less visibility when there's more, uh, because like the efficient markets hypothesis essentially is that, assuming, of course, you can have a strong opinion of the efficient market hypothesis. You can have strong, weak, strong, medium, weak. Uh, Efficient market hypothesis, where the strong is like everything is perfectly priced, even private information is known and reflected by the market. Or like strongest is that everything is efficiently priced, and then you can make whatever assumptions you want to make that gets you to conclude that that point is correct from that even material private information is reflected in asset prices to get you that perfectly priced security, right? Because to have a perfectly priced security, material, non-public information is going to have to be incorporated. Like, for example, if you have knowledge of the next company's earnings, and that is, so if you're going to have the optimally priced security, then that's going to be reflected somehow. Is this wrong? The medium is, as you might imagine, slightly distilled down. Maybe just assume like maybe only but public information is reflected, and then that creates a bit more room for alpha or just random variance. And you have the weak, which is that asset prices are much more flimsy and not necessarily as supported. But again, to each his own on which version you subscribe to. But generally, but the core idea is that with all three of those versions of the efficient market hypothesis, is that it comes down to information. Right, information about what a company does, what its future expected cash flows are going to be, or ultimately how much coverage is going to be from sell side analysts. So generally, the more noise there is, uh, that doesn't mean that when there's more noise or when there's more confusion or there's less visibility or it's not as well known by the market. It doesn't mean that means it's always going to be good. Because, for example, there's reasons for it to generate red flags, for it to not be the consensus thing. Because there's a reason for that. But at the same time, it creates the room for variance. And as Howard Marks said, in order to outperform, you have to be willing to. In order to outperform, you have to be different from the market, because if you're the same as the market, you'll have a beta of 1 and you won't have any alpha beyond whatever tracking error. You'll just get the market return if you are what the market or the majority is. And so to outperform and, of course, to underperform, you have to be different than the market. And certainly, and this might have a bit of a retail investor bias or direction too. But generally, I think when the average person hears about a state-owned enterprise, they probably would shy away from that, right? Or at least a state-owned enterprise creates more complexity than just say your traditional, or say one of your S&P 500 component companies like your Delta Airlines or your Microsoft, right? You mentioned your Microsoft or your Delta Airlines probably is a bit more appealing, gets a bit more inflows, is covered a lot more than the state-owned enterprise. Or look in this case specifically, right? I'm looking at a screen of some comparable companies to Petrobras, which is a Brazilian SOE, and so these are all comps, generally in Latin America, South America, for other oil or energy companies, right? And so you can compare these guys to say, like of course, like ExxonMobil or Chevron. I guess you could argue they might be in like a conceptual in a first principle sense, but in terms of like just nomenclature, right? Like these guys, as early as Petrobras, I don't know. Do you ever like I know EC? This is here. Yeah, like Eco Petrol, which I'm pretty sure is a Colombia. Yeah, Colombia. Definitely Petrobras, Eco Petrol, uh, Sinopec are SOEs, uh, but ExxonMobil and them are not. But I'm pretty sure. Actually, I'm gonna double check the comps. I'm not gonna save an image of it. Or I guess I should. And of course, the obligatory disclaimer that multiples are limited, and certainly EBITDA, enterprise value to EBITDA, is definitely limited when thinking about industrial companies where your depreciation is such a big reality of your company's existence. So, but that aside, okay. Uh, oh, I got rid of it. Ignore the PDF versus the PNG divergence. Uh, but the idea I want to make of SOEs is that I think there's a perception that SOEs are monolithic. They all operate the same way, or they all should be like tossed into the same bucket. Uh, when of course, generally, basically everything in life that's not a good, or that's not a good approach to have in life, and certainly not in finance and analyzing securities. And so that's certainly the case with SOEs. And generally, and I think generally, just as you know, there's a lot of like general ideas like there's more room to invest in say Japanese microcaps or even just like U.S. listed microcap or like smaller uh, listed companies. And of course, there's downsides to it. For example, Like some people might interpret that to be, speculate in penny stocks. No, that's not. No, that's certainly not the insinuation. Because again, there's a reason that some securities don't have liquidity and can't be listed on more liquid exchanges. But the general idea is that when there's more work to be done from your perspective, then that then ties into like you're probably different from the market, because the market again is the like Mr. Market, as Peter Lynch would say, but call it, is functionally the average of all market participants, buyers and sellers, from your retail investor to your Citadel internal hedge fund to your Fidelity mutual fund to your BlackRock ETF or iShares, just buying and rebalancing and whatnot, right? That's the market. And so you have active and passive participants. But generally, right, some active, right, and so generally the market has a finite attention, and there's so many securities, right? The U.S. There's like 6,000 public securities tossed into that. Then the rest of the world, China, India, UK, France, South Africa, Australia, Japan, right? There's just so many securities out there, and just generally, right? Then there's going to be mispricing somewhere. Because I personally subscribe to like I get a medium interpretation of the efficient markets hypothesis. But general idea is that like there's room for there's room for you to be different. Generally, again, like today, like you want to outperform and of course underperform the market. You have to be different from the market. And so that was talking about let's think about who the market is, contextualizing that. And so from that, then you can think about, well, do you want to be different from the market? And then, and from that, where do you think there is the room to outperform? And so the ultimate point took a while to get to is that SOEs provide an opportunity to be different from the market, because I don't think the market, or at least a certain subsector of the participants of Mr. Market, do not look into SOEs. Maybe they have a negative screen towards SOEs, or they are scared off by SOEs. So that's the idea. And so generally, I don't think when people hear state-owned enterprise, I think people like it seems like there's no way for them to like that those are like completely government held, and like in the idea of like there's like public securities, and then like with a government, so like they're public securities, but also if it's an SOE, it's literally it's a public company. So I guess in any sense, like they are public companies, in one sense or in another. It's like all SOEs are public companies, but not all SOEs are publicly listed companies. It's like like a cheeky turn of phrase. And so with that, there's definitely some interesting names. I mean, some of the names on here, like Petrobras, it talks about a lot when you read about Brazilian politics. Of course, various Chinese SOEs, like CITIC, Sinopec. A bit amusing that Bank of America popped up on the default China Construction Bank comps. But that's the idea. This idea is like at bare minimum, this functionally just reminded SOEs. You can invest in SOEs, and some of them are more attractive than others. So that's just and again, it's to the degree like that is always something to be reading about, and to outperform the market or to be different than the market is a way to get outperformance. But SOEs then is just another tool or another place to look at. And again, SOEs. I'm not going to go into like the pros and cons of SOEs at a high level, because I think the pros and cons of SOEs is kind of redundant, because again, as I said at the start, SOEs are so different with different governance structures, and so it's really not the most productive in that sense. But But again, just the point is this reminder, SOEs, some of them are listed. Like some of them have percentages of the company that are in the public float, uh, that are available for investors to hold. So, and again, like your specific judgments about like which companies or which geographies and SOEs, is up to you. But the general idea is that SOEs are on the playing field, and generally, not everybody will think that they are. So that's that. And again, to the point of like the coverage and liquidity and like Bank of America 1.6 times book value. At JP Morgan, I can only imagine what like JP Morgan's trading at 2-3 times book value. And then these SOEs you know have less than half percent or less than half times book value, which gets into like that not mispricing per se, because presumably the market, the discounting and whatever you think that's appropriate, overly conservative, overly aggressive discounting is up to you. But again, that's highlighting like the dynamics of potential mispricing, or just like the how SOEs get discounted. On that note, I wanted to highlight Petrobras. I always want to say Petrobras, but it's Petrobras, as I mispronounced it probably somehow. But it is an SOE, right? Trading at 4 times. Well, 4P is not the best, but and EBITDA is not the best because industrials, because there's so much depreciation involved with like because it's such a tangible business, your oil fields and all that. That the depreciation, it's a real cost. EBITDA, of course, like it doesn't really account for like maintenance capex, or something slip through EBITDA. And so for a tech company, maybe your EBITDA number is pretty reflective of cash, or maybe like it was when John Malone pioneered it with cable companies, which not as intensive as in oil companies, I'd say. But oil companies extremely capex, or certainly tangibly intensive. So highlight that. And so, anyways, the Petrobras, highlight at the bottom. And so, the general idea is just that I came across it. It seemed pretty interesting as an opportunity. Given with Lula being elected president in Brazil, and of course, and then there's I don't want to call it the same dynamic as it was with like the 20th People's Congress in China, and back in October of last year, which created like a pretty nasty shock to the Hang Seng, but then some really monumental like decade I haven't been seen in like 5 years buying opportunities, just because of like uncertainty, and the market doesn't like uncertainty, which then creates that mispricing that people can take advantage of. And so, John, I think Petrobras is an interesting name. It's highlighting like your U.S. oil majors, like Exxon, probably like best in class U.S. oil major, 4.x, Chevron, 5. I shouldn't use EBITDA. But yeah, right, like Petrobras compared to say your U.S. oil majors, trades at a significant discount. But this is a stock pitch. Not a stock pitch, but generally like in terms of like your dividend payout, Petrobras probably is much higher. Yeah, I guess I should pull up the cash flow statement so we can look at how much how much total dollars these firms put out. Actually, that's a good idea. I won't. I have Cap IQ up on a different browser, so I'm not gonna copy and paste it over. But ExxonMobil, look at its cash flow statement for the 2020 fiscal year. Repurchased 15 billion and paid 14 billion. Okay, so ExxonMobil returned $30 billion. XOM, 30 billion returned to shareholders. from fiscal year 2022, and you can check that yourself if you wish to. I hope I can read a cash flow statement after taking after being an accounting tutor. And let's go to Petrobras. Converting it to US dollars from a Brazilian real. And Petrobras paid out 36 billion. So 36 billion. So I guess in terms of payout, right? Yeah, of course, ExxonMobil, 15 million of that, or 15 billion was in share repurchases, and 15 billion was for dividend. But of course, dividends are more permanent, is general consensus, right? Share buybacks more opportunistic. So like that. But of course, to be fair, right, Petrobras, that was in fiscal year 2022 with pretty high energy prices. But common dividends paid before, like last year, 2 billion, excuse me, 12 billion, 2 billion, 2 billion. And so it does vary. But the idea, don't want to get too deep to Petrobras. But generally, it's an interesting alternative to the U.S. oil majors. You can come to your own conclusions about Brazil and you know your country risk premium or what you want to associate with that. But I do just want to highlight is the difference in Petrobras's common and preferred shares found under Handy. Honestly, reasonably appealing investor relation website. Some companies have pretty annoying or pretty lowbrow investor relations, but then some companies have pretty nice ones. I don't think Square is a good one because it just looks hilarious. Like it doesn't tell you a lot, but I do find this hilarious. This is objectively hilarious. Yeah, the box head. For like this is objectively hilarious. I just want to highlight that. But some companies have like I say like Apple's investment list. It's kind of like what you get for the most part, right? Like it's pretty standard looking. But yeah, this just looks hilarious. uh, but right. So back to the column. Right. So common shares get voting rights. The preferred share does not get voting rights, but is functionally or is essentially guaranteed some payout uh, from the company. And so generally, I say with that, the preferred shares are interesting, right? Especially if like you're an individual investor, how much value do you really associate to your voting rights? Like me, I own I voted in Spotify's recent proxy, and right, I have like 2 shares of Spotify, and like how much value do I really associate with those 2 shares of Spotify and the voting rights? If somebody offered me $1 to vote, and I would vote my 2 shares or give them the right to vote my 2 shares for $1, I would probably hand it over. If they give me $10, I would definitely hand it over. If they give me 50 cents, I would still hand it over because functionally, only owning 2 shares, it's the same. It's the same logic as to why there's the adage that voting in elections is irrational because what are the odds that one vote really matters? But then, of course, when it comes to like an election, your one vote really does matter. But when it comes to corporate governance and when the market with the indexers and especially the indexers, like your massive asset managers, uh, it creates a completely different dynamic. So it's not the most fair proxy. Uh, in that. So, really, and so the point is, how much do you really care about voting for Petrobras? Secondly, if it's an SOE and maybe you have doubts or hesitations about SOEs, uh, then how much do you really care about having voting rights in the SOE in the first place, right? And so generally, I think preferred shares is quite interesting in that way to essentially be guaranteed a payout. And then like, oh, is Lula gonna go Che Guevara on you? And I'll say, probably not. The same way, I would say that is China going full Marxist Lenin? No, because again, people are pragmatic to varying degrees, but at the end of the day, access to capital is good, and secondly, the marginal benefit of taking all the potential dividends that Petrobras could pay out is limited. Is the dividend payout for Petrobras probably going to go down? Yes, but was the dividend sustainable at the levels it was under Bolsonaro? Probably not either. So anyway, the point is that the preferred shares provides an interesting opportunity, and again, like the company is trading cheap is the point. It's Petrobras. It is trading cheap on functionally any metric you want to toss at it. Even from like a price to book, tangible book value, it's pretty cheap. So yeah, so again, I think like highlights again. This is reasonably educational, I hope. But so the point is SOEs, and then from SOEs you have Petrobras, as I think probably a really interesting example of an SOE to look at in a tangible way. Or you can look at Square and look at this hilarious and beautiful investor relations page because it is again this is hilarious. Apple Apple's exec team, Square's or Block, excuse me, Block's exec team. Absolutely hilarious. Okay, so that's that. So TLDR, SOEs, you can invest in them. Some SOEs are interesting. And Petrobras is an interesting example. And honestly, Petrobras is probably a really good case study for like how to think about SOEs. Like how much are you interested in the business itself, first off? Secondly, then, how much do you weigh like the corporate governance, or like how much do you care about the corporate governance or the risk of government intervention or whatnot? Um, and then I suppose then it becomes like your regular portfolio allocation question. But that's that. And so to wrap up, then let us look at airlines. This is a really good piece by Bern Hobart. I encourage you to sign up for his free, or at least the free part of his newsletter. In his piece today or yesterday or a couple of days ago was on airlines. And so I just want to highlight a couple of really interesting things because again, airlines. I've been flying on the plane since 2018, so it's been a while. But I say generally, right? Airlines, you know what they are. Like you probably interact with them to some degree, whether a family member, yourself, or someone you know who's on a plane or traveling somewhere. And so with that, it's always interesting to see how airlines, because we have the perception we have of how airlines work, and then the companies have a very different one. The airlines themselves have a very different way. For example, one way to think about airlines, like you think of an airline as like you pay a ticket, you pay the price of a ticket to go out on a plane, and the company flies you to somewhere else. But from the airline's perspective, and so is very different from how their business works. Because from the airline's perspective, it's much more so like involving rewards miles and like selling their rewards miles, like and getting the cash in advance and whatnot. So it's a very different perspective. Uh, so some interesting highlights. So general idea, right? Short flights have high cost, longer ones comparatively cheap. Just think about having high fixed costs, low marginal cost, right? To rent from a to rent like your hub at an airport. Hey, maybe some airports are SOEs on that note. Pretty sure some are, and some are. Yeah, like, the joke is like apparently um some some Mexican airline some Mexican airports are trading at pretty cheap levels. Apparently, something I saw. I haven't looked into it myself, but uh, which is a bit amusing. Uh, right. So again, you can like the Euro rationale, but again, that's the idea. Short flights, high costs, long ones comparatively cheap, right? Because your fixed costs are basically the same. To get the plane into the air, you have to do the same maintenance, same rent at the airport, and so then the longer ones, right, you can charge a bit more. And so your only marginal cost base, and you still need the same number of staffing. And so your only marginal cost is basically your oil, is your fuel, right? So that's just an interesting way to think about it. Revenue per segment. That honestly, I think this is a really interesting way to think about airlines as a business of getting some return as a return on plane business. Because like you think of like when you hear of like financial metrics, you think of like a return on like where return on asset, return on invested capital, return on equity. But when you think about a plane, like it really is literally when it comes to airline, it literally is a return on plane, which of course is functionally like a proxy for return on asset, essentially. But return on plane like really does distill what the business is, uh, which I think a really nice way to think about it. And then the very think how much of like the PP&E of a company is of an airline is the plane itself, is interesting. This is a really nice blurb. It talks about how smaller airlines are just like structurally advantaged compared to larger airlines to compete. You can pause, look into that. Cargo stuff, hubs. Again, it's like you have to hub. Um, I think it's interesting how like hubs. Like you think about like network effects or um, like hubs are kind of that. But I think this is a way. This is again just how like you have like your return on plane as a really interesting way to think about um, airline industry economics. I think this quote is another really interesting way to think about it. And that think about airlines as actually a manufacturing company. Uh, maybe I don't know. Maybe just because like maybe if you play Factorio or something like that, maybe this is a really amusing way to think about it. Um, but again, it really, if you think about it, it really is because like your hubs, uh, manufacturing connections. Yeah, that part seems a bit contrived, but again, like what is your output? You have fixed inputs because honestly, in airline, you have fixed inputs and you have fixed outputs. Uh, and so I think that's a really interesting way to think about airlines. Passenger. Yeah, something else that we forget is like I think people tend to fixate on say like leisure travelers, right? Because unless you're a business traveler, which most people aren't, then you're not really aware of or think about how it looks from the business traveler side. But of course, business travelers are where airlines make the most of their maybe not certainly the higher margin part, right? So it's interesting how like again to contextualize the differences. Uh, I think this is an interesting way to the degree that like data is really so interesting, and you wonder like how much data does the company keep on you. I think this blurb is interesting. Like like the 19-year-old traveling home from college, maybe traveling home from Boston, Massachusetts, with Harvard, Boston College, Boston University, MIT. Um, like the lifetime value of that Boston college student is probably pretty high, right? Working in pretty high wage roles, right? And then to get that brand loyalty, or at least brand recognition or tolerance, is pretty interesting. This is interesting. Whereas, like, think about what the ideal customer is for an airline, and if that's what the ideal customer for an airline is, and if you're ideal for the company, that's because the company gets a lot of money from you, lots of revenue, lots of profit, presumably, the good margins. And so, if the ideal airline customer is a brand loyal, takes last minute flights, and is always up for an upgrade, then maybe not be one or two of those things is a decent idea. I really like this phrasing. An airline's ability to exploit the economics of customer retention is partly a function of the airline's own internal discount rate, right? Of how do you weigh future cash flows to today's cash flows, or like future cash flows um, to the present day, um, right? And so think about, like, again, so the next idea of like your lifetime value of your customer, say your Boston college kid. Um, it's a really interesting view, um, because it's like you want to invest, you have $100 to spend, and you do want to invest $100 in something, and you know that the future cash flows of it, discounted back to today, are worth 200, but you have to wait 5 years for those cash flows to materialize. And so you need to wait those 5 years. But of course, if you need $100 and you can't, and you don't have those 5 years, and you have to spend $100 to survive the next month, then you can't realize that future future cash flows, right? So that's a really interesting view. And honestly, that's all every company is, right? So like, apply the same thing to like Meta, and it's like Facebook / Meta's metaverse reality labs push, which again is probably a bit overhyped in terms of spending, because it's not spending so much more on like AI stuff. But it's a really interesting view, or at the very least, like it's like you're aware of it, you're aware of this like reality, but just like reading it out loud contextualizes it. I found this to be kind of amusing, right? To the degree that like risk warnings from companies are kind of on the 10K, the risk section of the 10K is kind of legal copy and paste, but it's kind of amusing that like I quote, they read like a Stephen King novel, because they can actually come true, which is honestly just hilarious. Uh, Such as, say, this outbreak of diseases, 2019, of course, COVID. It's honestly that was it. But that stood out. I think the entire piece is very interesting. Like, has a lot more detail that I just did not cover. But honestly, I think that so much about finance is like so much of like, finance, for as much as it does seem a bit abstract. But once you do a bit of reading into it, or like read like Matt Levine or interesting writers like this guy, and you come to realize like how tangible, not maybe not finance, but the second order effects of financial markets are. And so I think like thinking about airlines in this way, from like the financial perspective, from a financial analysis perspective, is really interesting way to think about something that we all interact with in a pretty tangible way, in some sense. So that was 40 minutes. So thank you for watching. I guess I should do Champions League is on today. Have it on a second screen. Predictions today for no, I'll predict the screw it. Let's predict Champions League, Europa League, and the Conference League. Chelsea, Dortmund. Okay, so to recap, SOEs, they exist. You can invest them. Some interesting opportunities potentially, but your idea is like more room. There's more room for mispricing with an SOE than there is with Apple. Is the idea. And like get like offer me a penny stock or offer me SOE. The SOE is much more so a real business, all things considered. As a friend at Petrobras, is just an interesting thing to like, it's like do your due diligence, right? Look at the investor relations page, right? If the SOE doesn't have an investor relations page, then that's probably telling you something. But if they do, right, and they're telling you pretty useful stuff, then take a look at it. And just like take the information that they give you. It's in the investor relations pages. The most visible, forward-facing thing to look at. So, airlines, really interesting ways to think about airlines. That they're like they're functionally manufacturing companies. There were a return on planes. No, so that's that. Okay, so that's like the educational part of the stream. On to predicting the Champions League, Chelsea, Dortmund. I think because Chelsea, I watched the Leeds game from a couple of days ago. Chelsea, they do look they like have a bit hapless. So I think Dortmund against Chelsea looked pretty dangerous. Just like in terms of like running and moving. I could see Chelsea winning it, but I think Dortmund. I think Dortmund hang on like 1-1. I think like Chelsea Dortmund 1-1. Dortmund continue. Benfica, Club Brugge. Not sure what Club Brugge did hiring Scott Parker. But yeah, Benfica through. Maybe Benfica score 1 or 2. Maybe Club Brugge score 1. But Benfica through. Bayern, PSG. Neymar's out for the season. Maybe you have a more balanced front three, but I don't agree with that take. I think, especially if you're playing counterattacking, then I mean Neymar tracks back. It's like PSG have to go through. I think Mbappe will do more tracking back. So I think if you had Messi, Neymar, and Mbappe, that is a perfectly fine front three for the type of game you're going to play. But of course, Neymar's out. So at this point, I think Bayern can sneak it through. Tottenham, AC Milan. Yeah, Spurs. I think Milan. But I mean, both teams have been a bit disappointing. But I think Milan, just with like the 1-goal lead, which is massive, can see it through. So Chelsea, so Dortmund holding on, going through. Benfica holding on, going through. Bayern holding on, going through. Milan going. I have a Milan jersey on right now. I actually decided to shell out some bucks for a Milan jersey. I think it's one of the best kits in the football, alongside the Juventus kit, the Juve kit, and the Milan kit. Probably some of the best kits in European football. In global football, I think the Corinthians in Brazil and their Japanese Club World Cup jersey is pretty nice looking. So I suppose it is a bit lame because I just picked the teams that are winning on aggregate. But if you're winning on aggregate, you probably deserve it, right? I suppose in Dortmund game, maybe if Yao Felix can score some of those goals that go off the top crossbar, maybe they go through. But it's not just football. But yeah, Tottenham, I could see Tottenham, but if Charles de Clatterer ever wants to score, now's the time. But again, I really do think that like Spurs, can they get a goal? Yes, but I think Milan can also get a goal, and again, the 1-goal lead is pretty big. So again, to recap: Dortmund, Benfica, Milan, and Bayern München going through. On to the Europa League. Let's take a look. And so for these predictions, right, they're just starting around the 16. And so I will be predicting both legs. I'm not predicting the results of this game. I'm predicting the results of the entire leg. Okay, just want to have that be clear. Sporting Arsenal, yeah, probably Arsenal. I'll take Union Berlin versus Union Saint. That sounds French. Oh, Belgian. Yeah, which I guess is French. Yeah, Union Berlin. So Bayer Leverkusen to get past Monaco, a pretty entertaining tie. So I'll definitely take Leverkusen. Roma, Real Sociedad. Honestly, I'm gonna pick Real Sociedad over Roma. Actually, I take that back. Roma. I think Roma, Jose Mourinho, they can have over 2 legs. If a knockout, could see Sociedad, but in both legs, I think Roma can manage it out. Shakhtar versus Feyenoord. Shakhtar extremely lucky to move on against Rennes. I think Feyenoord have it. United, Real Betis, United. Juve, Freiburg. Honestly, I do have a very soft spot for Freiburg. But I think Juve have got it. And Sevilla, Fenerbahce, Bashe, I was pronouncing that. And Sevilla, I'll go with Fenerbahce. Sevilla have looked a bit, and certainly in the La Liga, not doing that well. So again, Arsenal, Union Berlin, Bayer Leverkusen, Roma, AS Roma, Feyenoord, Man United, Juventus, the old lady, and Fenerbahce in the round of 16 across both legs to go through. All right, so in a couple of weeks we can check back on that. And lastly, Europa Conference League. Well, I was expecting Alkmaar to be in the lead. With this, before the game, I would have said Lazio with Marzio Sarri. So I'll stick with that Lazio to go through across again both legs. Anderlecht versus Villarreal. Anderlecht, they had to come back against like wasn't an Azerbaijani team like Karabag. So I'll go with Villarreal. Sheriff and Moldova. I'll go with Nice. I mean, of course, Sheriff right had that really impressive Champions League run. Well, not run, but like they beat Real Madrid a couple years ago in their first Champions League showing. So I'll go with I'm still going with Nice. West Ham versus Larnaca in Cyprus. Gotta think West Ham have the ability to manage out the 2 legs. Ghent versus Istanbul. I'll go with I think Ghent also faced like an Azerbaijani team or something out in the Caucasus. I'll go with Istanbul. Basel, Bratislava. I'll go with FC Basel in Switzerland. Fiorentina over Sivasspor. And I'll go with the Polish club, Poznan, against Djurgården. And again, across both legs. So Lazio, Villarreal, Nice, West Ham, Istanbul, Basel, Fiorentina, and Poznan. So those are my European knockout tie predictions, and we will see if I'm correct or wrong. Maybe we'll do a stream looking at the sports betting companies like Penn and DraftKings. But certainly, either way, thank you for watching, and have a great rest of your day.